Hello and welcome to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Cameron May, 20-plus year veteran of the financial markets. He's there to help facilitate the conversation and keep things going out there. If you're here with us live, participate in that conversation out there in the chat. Make sure that it stays on the topic. And if you're here with us in the recorded version, leave us a comment. We'll get back to that comment as quickly as we can. We are grateful that you are here with us. We know that there are several of you that are here with us for the very first time. So welcome to all of you. Many of you are here with us for the frequent time that you have been with us. So we're glad to have our usual suspects with us as well. We're going to talk a little bit about index options today in light of what the market is doing, in light of what volatility is doing, and we'll manage a couple of the strategies that we've been paying attention to, including our 14 days till expiration, 7 days till expiration strategy. And then I want to look at something a little bit newer, a little bit shorter term, not newer necessarily, because the strategy isn't new, but the implementation here is a little bit more short term. So before we do that, a couple of quick housekeeping items that we need to take care of. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation of any particular security or strategy. Remember that investing involves risk, including the loss of principal. Past performance, no guarantee of future results. When we talk about index options, we talk about options on cash secured indexes. When we talk about options in general, remember they carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks, standardized options before considering any option strategy. Also remember that multiple leg option transactions, option strategies will require multiple transaction costs. That's just the reality. Second, remember that spread trading generally has to be done in a margin account. Now, one difference between equity options and index options, and one of the reasons why we teach this index options class as a separate webcast, is that the index options that we're going to be talking about are going to be European style index options, which means very simply that they cannot be exercised until expiration, which means that it removes the potential for early assignment of short options if you're trading those on European style index options. There are still other considerations to pay attention to, but one of those considerations that many traders are concerned about when trading options, and in fact being short an option, that early assignment risk is taken away when we're talking about European style options. Now, we're still going to be using the Thinkorswim desktop software platform. That desktop software platform is a great learning environment. We're going to be talking about the paper money version of the platform. The paper money version of the Thinkorswim platform, not a guarantee of future success out there in the real world, but it doesn't facilitate things like the early assignment of short options. So if you are trading equity options that have assignment risk, be aware of the fact that if you do those in paper money, you're not going to see that happen. But if you move that to a live trade, you may see an early assignment happen as long as you're not trading a European style index option. So there you go. All right, a couple of other things that we want to pay attention to. The fact that we're going to use technical analysis. It's not a guarantee of future success. Schwab doesn't, however, recommend the use of technical analysis as a sole means of investment research. Now, let's talk a little bit about where we are headed. For those of you who are brand new, we're going to talk about index options kind of in general terms. We're going to discuss some specific strategies. We're going to look at examples on the platform. So some of the strategies that we have employed in this particular webcast, we use vertical spreads quite often. In fact, one of the strategies that we use pretty much every week is the sale of a short call vertical or a short put vertical. So if you're not familiar with vertical spread methodology or vertical spread mechanics, we've got some great webcasts that can help you out in learning about those. We sometimes will combine those into iron condors. Rarely will we talk about butterflies. I'm going to talk about a condor trade, or excuse me, not a condor trade, a calendar trade today. And on a quite frequent basis, we will talk about using index options as a means to hedge a portfolio because they can be a capital efficient way, potentially, to hedge a larger portfolio that is sensitive to the movement of a particular index. And so we'll talk through some of those strategies as we get into this discussion. But a couple of other things to pay attention to. Whoops, I lost my charts there, or I lost my disclaimers. Okay, well, we'll pop over here to the Thinkorswim desktop software platform, which is fine. And we're okay with that. So we're going to take a look at a couple of really quickly get into the indexes here. We do this on an ongoing basis and taking a look at just how the market is moving. And this is one of the common uses for indexes is as a tracking mechanism for what the overall market is doing. The S&P 500, a broad cross-section of the market. And we can see that right now that S&P 500 kind of giving us a little bit of an up day, but it's still inside the range of yesterday's trading. Not a really strong momentum day, but not a bearish day overall. Second, the NASDAQ, the tech-heavy NASDAQ, the index that holds a lot of the technology stocks, starting to see a little bit of a gap down and then a bit of a rally today and some upward movement. And then the Russell 2000, which is primarily the small cap stocks with some financials, with a little bit of technology thrown in, kind of going sideways at the moment. You can see that happening on the RSI. All right. So, thank you, Greg, for reminding me. I wanted to make mention of this. I've talked about this before. We're going to make mention of it again. Next week, you're going to see the reality of it. Next week, the October 6th, the time for this particular class will change from 11 a.m. Eastern time to 3 p.m. Eastern time. And the reason for that is it allows us some flexibility to be able to place shorter term trades, including zero DTE trades, in the morning, and then I can manage those trades as we get into the afternoon towards the close of the trading day. So it gives us a little bit more flexibility in terms of strategies, and that's an opportunity. So next week, October 6th, we are going to be moving this class to that time frame, the 3 p.m. Eastern time frame, and James Boyd's class will flip flop to this time slot. So stick around for all of them in this particular case. So let's talk a little bit about what index options are. So for instance, I'm going to pop over here to the SPX. We were looking at the SPX a little bit. We had zoomed in on that SPX. We'll just use this as kind of their baseline. So an index option, for those of you who are brand new who have not traded index options before, this index is not a tradable instrument. It is a reflection of the prices in aggregate, either in a cap-weighted or a market-weighted, market cap-weighted or price-weighted function of the components of the index. So what that means is this price right here, this 6686.66, wow, that's a lot of sixes. As that moves, that's a reflection of the components of the index. Now, we can't buy or sell the index itself because it is a cash-settled index. It represents a certain amount of cash. What we can do, however, is we can trade options on that cash-settled index. What that also means is that if we buy or sell an option and we will hold it to expiration on a cash-settled index, we're going to either end up with cash in our account or we're going to end up with nothing in our account. We're not going to end up with a long stock position or a short stock position. It's going to be cash or nothing because it's a cash-settled index. For many traders, that makes things a little bit simpler in terms of settlement, in terms of management, in terms of risk. So let's say, for instance, that you bought an option, a long call option, for instance, which gave you the right to buy the underlying stock on an individual stock. and that option was in the money, you held that option all the way through expiration, theoretically, it would be automatically assigned, automatically exercised. You would end up with a long stock position in your portfolio. Now you got to deal with that long stock position in your portfolio. And the price of that stock could go up or down. You were to buy a long option position on an index, long call option position on an index. Let's say, for instance, we bought an in the money, deep in the money, long call on the SPX, and we let that go till expiration. Let's say we bought it deep in the money. We let that go through expiration. We're going to click on confirm and send. We're going to buy that option. We're going to pay $3,200.10 for it, or excuse me, $3,210 for that. And that represents an intrinsic value. So if we were to let that go through till expiration and it was in the money, we would end up with the intrinsic value of that option in cash in our account. Not a long stock position. Because you don't have that long stock position and that cash is cash, it doesn't have that overnight risk or that post expiration risk that ending up with a long stock position would have in your portfolio. So that's one of the reasons, again, why some traders trade index options, is for that cash settled component of this aspect. The other side of that coin is, though, because these are European style options, it allows us that flexibility, again, because of the characteristic of a European style index option to not allow exercise until expiration. There is no early assignment. So we could be short an option. And let's say we were to go in here to this October 1 and we were to short an out of the money call option. So let's say we were to create, or let's short an out of the money put option here in this case. Well, let's define the risk. And we were to go to the 66.40 and we were to sell that 66.40, we're going to bring in $110. Obviously, we've got to have some capital in our account because this index could go down. The likelihood of it going to zero is low, but at the same time, you got to have capital in your account to hold on to this particular position. We're going to talk about how we can mitigate that. But you're going to end up with, at expiration, the cash in your account that you brought in and no short position in the index, because you can't have a short position in the index. So that's kind of the nature. You don't have that early assignment risk. And so that's, again, one of the benefits for trading, or the potential benefits for trading index options. Now, we're not making a recommendation. These are simply explanations of these mechanisms and how these index options work. All right, now that we have that kind of understanding, and we've talked about this before, the rest of the mechanisms for index options is essentially the same as any other option strategy, right? Still have delta, gamma, theta, vega. You still have those option Greeks that function and work. And so you still have long options and short options. You can still create those same strategies. So Louis asks the question, no early assignment in indexes. No early assignment in short options in indexes as long as they are European style. There are some that are American style. It's a good idea to double check and make sure. One of the ways that you can check is you can go to the Market Watch tab. You can go to the public watch lists and you can see European style indices right there. Now you've got the entire list of European style indices. Not all of these have liquidity. So don't think that you've got, wow, this boundless range of European style index options that you can trade. Suppose you could, but at the same time, the majority of these have not a lot of trading liquidity. There's a fairly small amount of these indexes that have trading liquidity. So that's going to be something that we're going to talk about as we put this together. All right. So David asks a great question. Why are some European style? Why are some American style? Well, why are there Chevys and Buicks and Fords and Rivians and Teslas? They are different brands. They are different products. And they're offered as a function of different requirements. Index options came about as a function of a product for institutional traders to manage risk, and they continue to grow in popularity because of demand. So why are there some European and some American? Because there's demand for both. There is demand for both in that question. So good. All right, great question to ask. So let's come back over here. Let's take a look at a strategy, kind of ease you into this discussion in this strategy that we've been using. I'm going to go to the monitor tab. And this particular strategy that we've been talking about for quite some time is the idea of selling a vertical spread at 14 days to go until expiration, and buying that vertical spread back at 7 days to go until expiration. And we're doing it in a high probability way. We're doing it far out of the money, high probability of success, and we're doing it as a means to continually generate income and take advantage of time decay. Because in a far out of the money option, time decay hits hardest and most rapidly at the outset of the option. And it slows down as we get towards expiration. So selling 14 and buying back at 7, we're capturing the fastest rate of time decay. And that's working, that's the element that's working in our favor, as does directional movement, as does change in implied volatility. Those work for us or against us, depending on which direction they move. But time only moves in one direction. So it's the least uncertain of the uncertain elements and variables in our option trade. So what we have now and what we put on is a 64.50 short put, 64.30 long put. This is a short put vertical spread that we put on. We sold it for $1.90. We did this last week. $1.90 times 100 shares, so 190 bucks. It is now trading for 50 cents. The vast majority of the gain that we can make in this trade has already occurred. So we're going to buy it back and eliminate it. It doesn't benefit us very much to do this, to let this go until expiration. It benefits us to the tune of about 50 cents, but it's going to be really slow getting to that 50-cent gain. So there's the potential that the index could move within that time frame. I get that. So that's why we were selling at 14 days and buying back at 7. Now, Andrew asks a great question, which is, does this strategy best when only done once a week, or could you be beneficial by doing it multiple times a week on the same index? Sure. I'm doing this simply because I teach this webcast on Wednesdays, and that's why I'm doing this on Wednesdays. But you could create a strategy where you sell it on a Monday, a Tuesday, a Wednesday, a Thursday. Sorry, I had to do that, Monday, Tuesday, Thursday, Wednesday, sell the vertical spread. Now I'm doing the Godfather. Okay, look at what you guys did to this. Wow, you guys pulled me off topic already. No, that's okay. All right, sell it when you want to. I mean, that's the beauty of this. I'm just simply teaching the mechanics of the strategy. All right. So as we do this, let's go to the chart here and kind of see what we're doing, and I'll walk you through this discussion. The first thing that we're going to do is we're going to buy this one back and eliminate that obligation. It's taken the majority of the gain that it can make for us. We're going to create a closing order. We're going to buy back that vertical spread, and we're going to buy that back for about 55 cents. We brought in $1.90 to begin with. We're buying it back for 50 cents, 55 cents. And we're taking that trade off. Okay. Every time I try to get out, they pull me back in. All right, we're going to go ahead and we're going to fire that off and close that one down. We paid 60 cents for it, a little bit more, but starting to move a little bit. That's okay. So now what we're going to do is we're going to go to the charts tab. And we know that our 14 days to go until expiration time frame is the 15th of October. That's 14 days to go until expiration. So we're going to go to our chart and we're going to change this to our index grid. It's right here, index options grid. Right there. And our index is the SPX. So what I've done here each time is I've used the time level tool to give us a time hack. The other tool that I've got on here on this right-hand side chart is the probability of expiring cone at 1 standard deviation. So we're going to create a crossover between the time and 1 standard deviation. So we're going to go out, I'm going to eliminate this time hack. I'm just going to right click and remove that drawing. The time tool, that time level tool, is this one that's got a little clock and a vertical line. I'm going to click on that. And then I'm just going to move this over and I'm going to say, all right, I need to see the October 15th time frame. And there it is right there. I'm going to click and set that line and put it in place. That's my time hack. That's 14 days to go until expiration. So now what I'm going to do is I'm going to grab my line tool and I'm going to do the crossover between 1 standard deviation and that time, and it's at 6480. So I'm going to put that line right there. There's my line, my crossover line. That's where we're going to sell this short vertical spread. Now, the other thing that we're doing is when the SPX is above the 200 period moving average, we are selling put spreads because it's bullish. When the SPX is below the 200 period moving average, we are selling call spreads because those are bearish, and the index at that point is bearish. So we're selling a put spread at the 6480 strike. So we're going to go to the trade tab. We're going to open up the 15th of October expiration. We're going to go over to the put side of the equation, and we're going to go to 6480. That's it right there. About a 15-cent delta. So that means that option has about a 15% probability of being in the money at expiration, about an 85% probability of being out of the money at expiration. We're going to sell that one. And we're going to buy one that is 20 points wide from there. So 6480 to the 6460 is 20 points. We're going to buy that one. So we're going to get about $1.50 on this, maybe $1.70. A little bit less, but what's happened to volatility? Implied volatility has fallen just a little bit. When implied volatility is higher, we're going to get more premium. When implied volatility is lower, we're going to get less premium out of this strategy. This isn't a home run strategy. We're not trying to hit home runs. We're trying to do this again, repeatable, again and again and again and again. What also happens again and again is we get a feedback survey. So do me a favor, fill out that feedback survey. Let us know what you think about this webcast and what you like, what you don't like. But it's, you know, we strive to obviously make this a 10 experience for you. And so fill out that feedback survey. I don't want to shade anybody's opinions, but, you know, that's what we're going for. So $1.70 credit is what we're getting. We click on confirm and send. We read through this order. We make sure that that's what we want to do. This is to open our short vertical spread. Selling it for $1.65 in this case, which means that our max theoretical loss, because it's $25 or $20 wide vertical spread, is $1.80, or excuse me, $1.83 or $1,835 of max risk in the trade. But the likelihood of us taking that maximum theoretical risk is very low, 15% roughly. So that's the balancing probability here in this strategy. If you don't like that, narrow the spread. If you don't like it, sell it further out. Those are the choices. It's going to change the amount of premium that you're going to get. It's going to change the mechanics of the spread, or the numbers, the mathematics of the spread. And we're going to go ahead and we're going to click on Index Options Weekly. That's where we're going to put this. Ernest, yes. In fact, you can watch this. This is recorded. You can watch this in our Trader Talks webcast page, and I'll show you that here in just a minute. So we're going to click on Send, and we're going to fire that order off, and we got it for $1.70. So there's our short vertical spread. And the short vertical spread expects that the price of the stock, the price of the index, is going to stay above 6480 between now and expiration, for sure, but between now and the next 7-day time frame. We're going to buy that one back at 7 days, come what may. That's our 14-7 strategy. We're not trying to get maximum theoretical gain. We're not trying to get a home run. We're just trying to bring in premium every week. Father Guido Sarducci had a great Saturday Night Live sketch where he talked about the cost of sin. And he talks about, you know, you bring in 25 cents and a 25 cents and a 25 cents, and pretty soon you got a lot of money. So you bring in a buck 40 or a buck 60, and you do that again and again and again and again, that starts to add up. The problem is, the offset to that is you could take a loss. You could wipe out some of those smaller gains. That's the risk. Now, Harry asks the question, does it make sense to have a loss exit? In this particular case, we don't do that. We don't manage that. We manage this for the spread, but we're doing this in such a high probability way that the likelihood of us getting hit gives us some time for that scenario to play itself out. Doesn't mean that we can forget about this, but the problem is, even with indexes, that when you have trades that have two components, a short leg and a long leg, you're going to have some widths because you're dealing with essentially two different bid-ask spreads. And so the volatility, if we were to put a stop order on this trade, that volatility, especially as the market opens, could take us out of the trade, and then the vertical spread continues to go on and do exactly what we wanted it to do anyway. So you could put an alert if you wanted to, but we're not going to manage you're not going to manage the risk side of this, other than making this a risk-defined trade. At least in this case, we don't. I'm not teaching it that way. You can do it, not a problem. But that's how we're going to manage this, and we're going to look at just taking this off at 7 days regardless. Okay. All right. So there's our 14-7 strategy. Now, that being said, let's go back to the charts again. And I wanted to take a look at one other strategy here. And this is RUT. This is our Russell 2000 strategy. And what we've done in this particular strategy is we have a diagonal spread. We have a long call diagonal spread on the Russell 2000. So I'm going to come back to the monitor tab and we'll talk through this strategy. We'll talk about how we might manage this. So what we've done is we've got this long call, the 2355 long call, which expires on the 24th of October. And we've rolled this a couple of times to keep that directionally going in the direction we want it to go. Right now, the most recent roll that we did, I think, was last week, and we rolled it to this strike and an expiration, the 24 October expiration, for a net of $87.45. That's the net that we've paid for that leg. It's now trading at $105, so it's gone up. We've gained a little bit in this particular case. And we sold at the same time the 8 October expiration 2430 call option. And it's now trading at $27, about half of what we were paid for it to begin with. Think about this strategy, this diagonal spread strategy, as similar to being a covered call strategy, where the long call option serves in place of owning the underlying stock in the strategy concept. It's not the same as owning the underlying stock. We know that. Options are different. Options expire. Options don't have dividends. They don't have voting rights, those types of things. But this is serving in place of that ownership of the underlying stock, allowing us to sell this shorter term call. So we're going to do two things here. One, we're going to roll this long leg. And two, we're going to roll the short leg. Now, I could do it together. but I'm going to do it individually just to show you how we're going to do this. So what I'm going to do is I'm going to roll this one out. And we're going to go to the trade tab to look at this really quickly. So we're going to look at the Russell 2000. Here's our long leg right down here. And you can see that that's relatively deep in the money. It's at the 76 delta, which means it's losing a little bit of leverage. It's not terribly deep. But I want to just roll this down to, say, the 2400 strike, to one that has about a 65 delta, a little bit more leverage, a little bit lower cost, and we're going to book a little bit of profit in this particular case. So I'm going to roll this down and out for time. So what I want to do is I want to pick an expiration that I can roll this to, say, for instance, the 7 November, and we're going to roll this to the 2400 strike. Okay, we're going to roll that to the 2400 strike. So I'm going to roll this long leg. Actually, scratch that in this particular case. So Healthy You asks the question, why roll it? Why not just buy it back? Well, that's all we're doing with a roll. A roll is simply buying it back or selling it back and then buy another one. And all I'm doing is I'm extending the duration because it extends into the uptrend, continuing to move to the upside. So a roll is not a magic wand. A roll is just simply for convenience. Now, here's the thing. In terms of the order of operations here, and I just thought about this, if for some reason I were to initiate this roll on the long leg and I sold the one that I'm currently long and I did not get filled on the one that I want to go long, right? If I got filled on the closing side of that roll and not filled on the opening side of the roll, where would that leave me, guys? Just quiz for you. Where would that leave me if I did not have a long leg in this particular case? That would leave me at a naked short on that 2430 call. Now, here's the thing, and I've used this joke in the live environment before, and you know that I've used this in the live environment before. You know what's coming if you've been there. Being naked on purpose is one thing, but being inadvertently naked, that's an entirely different scenario. I don't want to be inadvertently naked. So I want to accomplish the roll first on my short leg so that I've got that short leg in place and it's already dealt with. And so we're already going to roll that, and where it's not at that point. Now, granted, these are European style, so there's not a likely scenario for early assignment because they don't allow early assignment in these. But it's just a good habit to get into. It's just a good habit to get into. So I'm going to manage the short leg first. Right click, and we're going to roll this. So we're going to go to the trade tab again. We know that here's where we're short. Here's our short leg here on the 7th of, or the one that expires on the 8th of October. And our short call is right here. So I want to roll this to a little bit out of the money. I'm going to roll that to the 2450 strike. And I'm actually going to keep it in the same expiration in the 7 days to go until expiration. Maybe we'll roll it out a little bit more, but I'm going to roll it to the 2450. And let's see if we've got some additional duration. Let's go to that 15 October and roll this out to the 2450. Yeah, we can get a little bit more premium if we do that. So let's go back to our monitor tab, right click, and we're going to create a rolling order. So the first thing I'm going to do is I'm going to adjust where I'm going to roll to. I'm going to roll this to the 15th of October. And I'm going to roll it from the 2430 strike to the 2450 strike, which means I'm still getting to that $3.45 credit. Doing it right now, Bob. So here we go. $3.50 credit. We're going to roll to that leg. And we're going to roll it in that index options 2 open and 2 close. We're going to click on send. And we rolled that short leg for a net credit of $3.55. Okay, now that's dealt with. Okay. Now we go to the monitor tab, and we're going to roll this long leg. And we're going to create a rolling order. And we're going to roll to, we said the 19, actually, we said the, what was it, the 28. I'm going to have to go back to the trade tab again and see when we were going to roll that long leg. We were going to roll it to the 7th of November. So there we go. Now we're going to adjust that. Whoops. Come back up here. And we're going to roll that to the 17th of October, or 17th of November, excuse me, 7th of November. There it is. And we're going to roll this to the 23,400. There we go. Or excuse me, 2,400 strike. Click on confirm and send. We're going to book a little bit of profit on this trade and click on send. And now we've created that diagonal spread, that diagonal spread. Okay, now we've created that diagonal spread. We've rolled that diagonal spread. We brought in a little bit of premium. We or booked a little bit of profit on the long leg. We brought in a little bit of credit on selling the short leg a little bit further out. And now what we have is a diagonal spread that is 37 days to go until expiration on the long leg, 14 days to go until expiration on the short leg. And we can manage it from there. We're going to continue to keep that diagonal spread going. So there's that diagonal spread. Now, what we're going to look at is the possibility here of doing a calendar spread on this same index. Again, cash secured index, you're bringing cash in, that cash is providing that cover. As we get into, let me see what time it is. Okay, we got about 10 minutes left. All right, that's okay. So let's do this. We're going to talk about a calendar spread. Now, there are some challenges to this calendar spread. What I want to do is I want to take us out really quickly to our resources in this particular case. So if you want to learn more about these particular strategies, I'm going to come over here to the Trader Talks webcast page, and I'm going to ask you to click on subscribe. In this case, when you click on subscribe, that allows you to set alerts on new information, new webcasts that are being put out here, and archives that are dropping. It also makes you a part of this Trader Talks webcast community. You can get there the same place by clicking on that subscribe button down on the bottom right-hand corner of your screen. But what I'm going to type in here in the search box is diagonal first. And now you've got a whole bunch of webcasts that talk about diagonal spreads. Okay, a whole bunch of webcasts that talk about diagonal spreads. The second thing that I'm going to type in here is calendar. And you've got a whole bunch of webcasts that talk about calendar spreads. And a calendar spread is like a diagonal spread, but you are splitting not the strike price, but the expiration. So let's put together a diagonal or a calendar spread here on our Russell 2000 discussion. So I might think that the Russell 2000, because it's kind of getting into this neutral range here, might stay just about where it is over the next few days. So we're going to go to the trade tab once again for the Russell 2000. Now, this is a spread that could be accomplished in shorter time frames. I'm going to do this in a little bit longer time frame. So I'm going to go out to a little bit longer in relative terms. What I'm looking for is a disparity in implied volatility. So I'm looking for an elevated implied volatility on the month that I'm selling, or on the expiration that I'm selling, and a lower implied volatility on the expiration that I'm buying. So I'm going to go to the 2 days to go until expiration, and I'm going to go out to about the 12 days to go. Actually, let's go a little bit shorter, 7 days to go till expiration. There's a little bit wider dispersal between those two implied volatilities. So we're going to go to the 7 and the 2. Now, I want to look at my chart here, and I want to look at this from the perspective of where this might go and where we might have liquidity. So in that time frame, in the next couple of days, where might the index go in the next couple of days? So I've got a resistance level up here about 24.52, and I've got a support level down here about 24.20. So 24.50, maybe 24.40, and 24.20 on the downside. The reason I'm doing that is I want to kind of select where I think this index is going to go. So I'm going to look for where there is some premium to be had. So 24.20 to the downside is a little ways to the downside. I'm going to split the difference, and I'm going to sell the 24.25 put option and expect this to maybe move down a little bit here. Okay. So we're going to sell the 24.25, bring in $8.80 of credit. Now we're looking at the 7 days, or actually 6 days to go. Where did we say? 7 days, 8 October. and we're going to go to the 24.25 strike if we've got a 24.25, and we're going to buy that 24.25. So we're going to be doing this at a net debit of $8.20. I'm going to right click and click on Analyze Trade, and we're going to show just this spread. So I'm going to take our diagonal out, and here's our calendar spread on our Analyze tab. So my expectation is, let me kind of spread this out a little bit more and bring it back. My expectation is that the index is going to drift down a little bit to that 24.25 strike, the midpoint of that strike. Okay. And that's where we see the maximum theoretical gain on this trade. What we're going to look at doing is taking this trade off, however, before we get to expiration. So we're going to take it off if it gets into this range right here at about that 24.13 range to about the, or excuse me, 24.41 to about 24.38. So somewhere within that range of those two areas, we've increased the probability of success in this particular trade. Okay. And in this particular case, we're not looking at getting to that max theoretical gain. If we do, we get lucky in the trade. But this is a scenario where our maximum theoretical gain, because these are two different instruments, is not calculated. But we know what our maximum loss is in the trade. The maximum loss in this trade is what we paid for it, the $825, or the $8.25. Okay. So this calendar spread, low probability of success, but low cost to entry. And if we get lucky and that ends up on that strike at that 24.25, we may get max theoretical gain. And we're doing this for a short period of time. So we'll continue to manage this as this continues to move forward. All right. So as we take a look at this again, a quick reminder, here's where you find more information about these particular strategies. And let me show you the index options playlist. For those of you who are brand new in this discussion, here's our trading index options playlist. And we talk about a variety of different strategies, including hedging, rolling those diagonals, what happens when VIX is going up, the liquidity risks at 0 DTE. And then as we start to move the time frame of this webcast starting next week, we'll start to examine more of those 0 days till expiration strategies, because then we can talk about the management as we get to the end of the day and see how those strategies might be managed. So for those of you that are just joining us, have just joined us for the first time in this webcast, thank you for being here. We appreciate you joining us for these webcasts. For those of you who have been with us around for a long time, thank you for your conversation and being a part of the conversation. Follow us over here at schwab.com/coaching. That's where you're going to find information about our upcoming in-person events, as well as our entire calendar of live webcasts and virtual workshops as well coming up. But here is the October calendar, and you'll see starting next week, there is that in trading index options webcast right there, 3 p.m. Mountain Time, or excuse me, 3 p.m. Eastern Time, 1 p.m. Mountain Time. Guys, thank you very much. I appreciate you being here. I appreciate Cameron May for helping out and our great production staff as well, and you all being a part of the conversation. Remember to fill out that feedback survey, and we'll see you guys again very soon. Take care, everybody. Bye-bye.